Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about something really important, taking control of your financial future. Today, we're diving into the brilliant ideas from Jessica Spangler's book, Invest Like a Girl. We're going to cut through all the noise and confusing advice out there. What we're doing here is boiling it all down to a simple, powerful plan that anyone can use to start building real, lasting wealth. So, here's the roadmap. First, we're going to tackle the big question. Why does any of this really matter? Then we get honest and figure out exactly where you stand financially, right now. After that, it's all about building a solid foundation, getting your head in the right space for investing, and finally, we'll get to the simple, practical strategies that can truly put you on the path to financial freedom. You know, before we even think about spreadsheets or stock tickers, Spangler insists we start with our why. Because this isn't just about crunching numbers, it's about your life. It's about understanding the real emotions and the high stakes that are tied to every single dollar you make and every choice you make with it. And Spangler kicks things off with a story that, honestly, it just stops you in your tracks. Her dad's sudden passing wasn't just a family tragedy, it was a financial earthquake that threw everything into chaos. This story really drives home the central point of the whole book. Financial independence isn't a luxury. It's not just a nice to have. It is the bedrock of your security and your freedom. And building on that personal story, Spangler points out how society kind of subtly feeds us these really limiting ideas about money. And this is especially true for women. You know this stuff. Be cautious, save your pennies, focus on clipping coupons instead of learning how to actually grow your money. These messages, they create fear and hesitation. They hold people back from making bold moves that could change their lives. And this isn't just a feeling or a vague idea. It has a real-world dollars and cents impact. That 82 cents, that's not just a number on a chart. You stretch that out over an entire career, and it adds up to a mind-boggling amount of lost income, lost opportunities to invest, and ultimately, lost freedom. It's a stark reminder of why it is so incredibly crucial to take charge of your own financial destiny. Okay, so how do we actually start fighting back? Where do we begin? Spangler's first move is so simple, but it's incredibly powerful. You have to know exactly where you are today before you can even think about plotting a course for tomorrow. It's time to take a clear, honest, no judgment look at your finances. So let's start with the good stuff, your assets. This is basically everything you own that's worth money. The cash in your savings account, your retirement funds, your car, your house. If you could sell it for cash, it's an asset. This is your financial firepower. This is what you have to work with. And then we have the other side of the ledger, liabilities. This is all the money you owe to other people. Your student loans, that credit card balance, the car payment, the mortgage. And look, Spangler knows this part can be intimidating. It can be scary to look at that number, but you can't defeat an enemy you're not willing to look in the eye. And this is where the magic happens. You take what you own, you subtract what you owe, and what you're left with is your net worth. This one number, this is your financial snapshot. It's your starting line. It doesn't matter if it's big or small right now. What matters is that you know it. Because knowing it replaces that vague, free-floating anxiety with a solid, concrete starting point. Okay, so you know your starting point. Now, how do you manage the money that's coming in every month? Spangler is a huge advocate for the 50-30-20 rule. I love this because it's so simple. 50% of your take-home pay goes to your absolute needs: rent, food, utilities. 30% is for your wants, the fun stuff that makes life worth living. And that last 20%, that's non-negotiable. That's for your future self. All right, you know your numbers, you've got a budget, you're probably eager to start investing, right? Well, Spangler says, hold on a second. Before you go on the attack, you need to build your defenses. You need to build your financial armor. This is the stuff that's going to protect you and let you invest with confidence for the long haul. Armor piece number one, you got to deal with high interest debt. We're talking credit cards, personal loans. That stuff is like a hole in your financial boat. The book lays out 2 great ways to tackle it. The avalanche method is the most efficient. You go after the debt with the highest interest rate first, saving you the most money. But the snowball method is all about psychology. You knock out the smallest debt first, get that quick win, and build momentum. Honestly, the best one is the one you'll actually do. The next piece of armor is, and I can't stress this enough, absolutely crucial. It's your emergency fund. This is 3 to 6 months of your essential living expenses sitting in a boring, safe, easy-to-access savings account. This is your financial shock absorber. It's what makes sure a flat tire or a broken appliance doesn't become a full-blown financial catastrophe. And now for what is, without a doubt, the easiest money you will ever make in your entire life, your 401k match. If your company offers to match your contributions, you put in enough to get every single penny of that match. Period. No excuses. Spangler is super direct about this because it is literally a 100% return on your money, instantly. It's free money. Don't leave free money on the table. Okay, your armor is on, your defenses are strong. Now the fun begins. It's time to switch from playing defense to playing offense. It's time to stop just protecting your money and start making your money work for you. It's time to start thinking like an investor. So when you hear that word investing, what pops into your head? For a lot of people, it's that chaotic scene from the movies, right? Guys in suits screaming buy and sell, trying to perfectly time the market's every move. But does that actually work in the real world? Let's take a look at the data. Okay, just take a second and look at these numbers from Bank of America. They're absolutely wild. If you just stayed invested from 1930 to 2020, through every war, every recession, every boom, you'd have a return of over 17,000%. But if you tried to be clever and you jumped in and out and you missed just the 10 best days each decade, your return completely collapses to a measly 28%. The lesson here could not be clearer. Real wealth is built by time in the market, not by timing the market. This leads to a huge mindset shift that you have to make. Investing is not the same as gambling. It's not a trip to Vegas. When you gamble, the odds are designed for you to lose. When you invest, you are buying a tiny piece of ownership in a real business that makes real things or provides real services. You're making a long-term bet on human innovation and economic growth, a bet that has paid off big time for over a century. So we get it. We've got the right mindset. But now for the big question, right? How do we, actually do it? How do we put our money to work? This is where Spangler's advice is so refreshing, because she argues that the most effective way to invest is usually the simplest. And the absolute hero of this simple approach is something called an ETF, an exchange-traded fund. Now think about it this way. Instead of trying to find that one needle in a haystack, that one perfect stock that's going to take off, what if you could just buy the entire haystack? That's basically an ETF. With one purchase, you can own a tiny slice of hundreds or even thousands of different companies all at once. It's instant variety, instant diversification, all in one easy step. And the book lays out some fantastic, simple strategies to get you going. If you're someone who just wants to set it and forget it, the lazy luxury strategy is perfect for you. If you want a little more stability to go with your growth, the classic 50-50 split is a time-tested winner. And if your goal is to have your investments pay you a regular income, the dividend queen strategy is the way to go. The point is, there's a simple, clear starting line for everyone, no matter what your goals are. But look, at the end of the day, you can read all the books and watch all the videos in the world, and none of it matters if you don't take action. Spangler's final and maybe most important point is just this. You have to start. You have to open the account. You have to transfer the money. You have to click the buy button. Every single day you put it off is a day of potential growth that you will never, ever get back. The most powerful move is just to get in the game. So there it is, the complete roadmap, the path from financial uncertainty to financial empowerment, broken down into simple, doable steps. You have the knowledge now. The power is completely in your hands. So the only question left to answer is the one you have to ask yourself. What are you gonna do next? The whole idea of investing, it can feel huge, right? Kind of overwhelming. Like you're standing on the outside of this big, complicated world, and you're not even sure where to find the door. Well, today, that's what we're doing. We're building that door. We're going to turn all that anxiety into a super clear, actionable plan. And we'll do it by focusing on 5 critical steps you need to nail before you even think about buying a single stock. So let's get into it. So here's our game plan. First, we'll cover the primer, why all this prep work is, well, absolutely essential. Then we're going to walk through 5 solid steps. Getting a real look at your finances, getting a handle on your cash flow, building up your financial defenses, and then finally getting you ready for liftoff into investing. And we'll wrap it all up with a really important mindset shift that honestly changes everything. All right, first things first, the primer. Let's think of it like this. You wouldn't try to build a house on a foundation of sand, would you? Of course not. The exact same idea applies to your money. If you want to build real, lasting wealth, You've got to have a rock-solid foundation. This prep work isn't just a nice to have, it's the very bedrock of your whole financial future. The author of our source material here uses this fantastic analogy. Picture it. You're impatient, so you toss a pizza into a cold oven. And yeah, eventually you get something that kind of looks like a pizza, but the crust is soggy, the cheese isn't really melted. It's just a letdown. Well, jumping into investing without a solid foundation, that is the financial version of that soggy pizza. You might get some results, but you're really just setting yourself up for a pretty disappointing and maybe even costly outcome. This quote from the author's mom just hits the nail on the head. And doing a job right doesn't mean you have to be perfect. Not at all. It's about having a little foresight. Setting things up now so you can avoid major headaches later. It's about building a system for your own success, which is exactly what this 5-step checklist is going to help you do. And here they are, the 5 steps that make up that system. First, figure out your net worth. Second, you got to set a budget. Third, build up an emergency fund. Fourth, get rid of that nasty high-interest debt. And finally, number 5, set up your retirement accounts. Now, don't feel like you have to do all this overnight. Some of these take time. The most important thing is just to start. All right, let's jump right into step 1, getting the full picture by calculating your net worth. Now, let's be honest. For a lot of people, this is the scariest part of the whole process, and I totally get that. But facing this number, it's not about feeling bad or judging yourself. It's about empowerment. It's about finding out exactly where you're starting from so you can draw a map to where you want to go. This comes straight from the author, who told this really powerful story about how she avoided looking at her 6-figure student loan debt for years. The fear, the anxiety, it was just paralyzing. But the second she finally looked at the actual number, all that fear it changed. She felt empowered. Why? Because for the first time, she had a target. She could make a real plan. That's what happens when you face the numbers. So how do we actually do this? Well, it's a super simple calculation, and it's based on just 2 things. First, your assets. That's just anything you own that's worth money. Cash, your house, your car, any investments you might already have. And second, your liabilities. That's just a fancy word for anything you owe, like a mortgage, student loans, or credit card balances. The formula could not be simpler. It's just your assets minus your liabilities. That equals your net worth. So in this example here, you add up all your assets, which comes to $251,500. Then you add up all your liabilities, which is $205,000. The difference is a net worth of $46,500. Now, listen to me on this. Your number might be positive or it might be negative, and that is perfectly okay. The number itself doesn't matter nearly as much as knowing it. This is your starting line. And here's the key. Watching this one number go up over the years is the single best report card for your financial health. Okay, so once you know your starting point, it's time for step 2, mastering your cash flow. Now, the word budget, I know, it probably makes you want to run for the hills, right? But I want you to forget the whole idea of a budget being this restrictive, joy-killing chore. Instead, think of it as a tool, like a GPS for your money. It just shows you where your cash is going right now, so you can start telling it where you want it to go, like into your investments. Now, a really simple, really effective place to start is something called the 50-30-20 rule. It's more of a guideline, really. It's flexible and it's super easy to remember. The idea is that you take your after-tax income and you split it up. 50% goes to your needs, 30% goes to your wants, and a non-negotiable 20% goes to your future. That last bucket is for savings and investing. So let's see what that actually looks like. Say your monthly take-home pay is $5,000. Well, that means $2,500 goes to needs, things like your mortgage and groceries. Then you get a full $1,500 for wants, all the fun stuff like going out, travel, shopping. And this is the most important part, $1,000 gets automatically pointed towards your future self. See? It's a balanced approach. It doesn't ask you to give up everything you love. I love this line from the source material. It's such a powerful way to think about it. Paying yourself first, putting that money into your future bucket, it's not optional. It's not whatever's left over at the end of the month. It's a bill you owe to your future self. And it's probably the most important bill you'll ever pay. All right, with our budget dialed in, we're ready for steps 3 and 4, building our financial defenses. You can think of this stage as putting on your financial armor. This is the safety net that's going to protect your long-term investment plans from, all the curveballs life is going to throw at you, and from the crushing weight of expensive debt. First up is your emergency fund. The goal here is pretty simple. Save up 3 to 6 months of your essential living expenses. And why is this so critical? Well, think about it.
If you suddenly lose your job or get hit with a huge unexpected bill, this fund is what stands between you and total financial disaster. It keeps you from having to sell off your investments at the worst possible time just to make rent. And you'll want to keep this cash in a high-yield savings account, where it's safe, you can get to it easily, and it earns a little bit of interest.
Okay, now for the other half of your financial defense, attacking debt. And it all comes down to this number you see on the screen, 7%. The author defines any debt with an interest rate of 7% or higher as high-interest debt. And you need to think of this stuff as a financial anchor that's just dragging you down. We're talking about credit cards, payday loans, that kind of thing.
And the author uses this fantastic metaphor from Greek mythology. Sisyphus was this guy who was doomed to push a huge boulder up a hill for eternity, only for it to roll right back down every single time he got near the top. Look, if your investments are earning, say, 10% a year, but your credit card is charging you 20% in interest, you're always losing ground. You're just working against yourself. It's a battle you simply can't win. That debt has to be your number one priority.
So, how do you actually attack it? Well, there are two main strategies. You've got the avalanche method, where you focus on the debt with the highest interest rate first. Mathematically, this will save you the most money. And then there's the snowball method, where you pay off the smallest debt first. That gives you these quick psychological wins that build momentum. So which one is better? Honestly, it's the one you'll actually stick with.
We've built our foundation. We've built our defenses. Now, and only now, are we at step 5. It's time to prepare for liftoff. This is where you actually get to start investing, but we're going to do it in the smartest way possible by using special accounts that come with some pretty powerful tax advantages.
Okay, so here's the cool part. The government actually wants you to save for retirement, and they give you these awesome tax breaks to encourage you. You basically have two main choices. With a traditional account, like a 401k or IRA, your money goes in before taxes, which lowers how much income you pay taxes on today. It's a tax break now. With a Roth account, you put in money after you've already paid taxes on it. But the magic of the Roth is that all that money, including all the growth, comes out completely tax-free in retirement. That's your tax break later. A good rule of thumb, if you think you'll be earning more and be in a higher tax bracket when you retire, the Roth is often the way to go. And if you're wondering just how powerful that tax-free growth can be, just look at this number, $5 billion. That's the estimated value of PayPal co-founder Peter Thiel's Roth IRA. He was able to invest in startups like Facebook inside his Roth account. Because of that tax break later deal, that $5 billion can be withdrawn completely 100% free of taxes. Now, it's an extreme example, for sure, but it shows you the unbelievable power of letting your money grow without the government taking a cut. Now, before you do anything else, listen to me on this. If your employer offers a 401k match, you have to take it. This is not a suggestion, it is a non-negotiable. An employer match is free money. It is literally a 100% return on your investment, guaranteed the second you put the money in. Your company is trying to give you a bonus. Contributing enough to get the full match is the absolute bare minimum you need to do. Do not leave free money on the table. Okay, so we've covered the 5 big steps, we've laid the groundwork, we've built the foundation, but honestly, the most important piece of this whole puzzle isn't about accounts or spreadsheets or numbers. It's about a fundamental shift in how you see yourself and how you see your money. It's about making the leap from being a consumer to becoming an investor. And this is the final thought I really want to leave you with today. Every single day, you spend your money on products and services from companies you use and believe in. A consumer just spends that money and that's the end of the transaction. But an investor asks a different question. What if I owned a small piece of this business? The moment you start thinking that way, you're not just a passive customer in the economy anymore, you become an active owner. And that right there is the true starting point for making your money really work for you.
All right, welcome. You know, if you've ever looked at the world of investing and thought, wow, that is some super complicated mystery that's just not for me, I've got some really good news for you. It's so much easier than you think. Today, we're going to cut through all that noise and show you exactly how to go from being a saver to a confident investor. Okay, so here's our game plan. We're going to walk through 6 key ideas that are going to completely change how you see your money. We'll start with why just saving money isn't enough and talk about the hidden enemy called inflation. Then, we'll get to the fun part, the absolute magic of compounding. We'll bust the myth that investing is just gambling. I'll give you a simple playbook to get started, and we'll finish with the most valuable thing you have, and that's time. So let's kick things off with a story. It's a story about a simple change jar and that moment you realize, hey,
The tricks that worked when we were kids just don't really work for our big adult-sized goals.
This quote right here, this really gets to the heart of it, doesn't it? It's the biggest thing that holds most of us back. This feeling that you need some special finance degree or a secret password to get in. But holding on to that belief is what keeps you on the sidelines. And as we're about to see, the real mystery isn't how investing works. It's why on earth we wait so long to start. I still remember being a kid, watching my dad come home and empty his pockets into this big glass jar. And my one mission in life was to save up enough of that change for a Game Boy. It felt like pure magic when those coins were finally counted and I got the prize. But, as an adult, that magic kind of wears off. You look at that same jar and you think, $50 after all that time? Yeah, there's got to be a better way. And finding that better way becomes really, really urgent when you meet the main villain of our story. It's this nasty little bug called inflation. And believe me, it is quietly eating away at your hard-earned savings every single day. So, to put it simply, inflation just means your money loses its power over time. The $100 you have in your wallet today, well, it's going to buy you less stuff next year than it does right now. It's like this silent tax on your wealth that you don't even notice until you go to buy something and think, wait, didn't this used to cost less? Okay, now here's the crucial point. While prices for everything are going up, this is what a typical savings account pays you. 0.06%. It's basically the financial version of trying to fill a bucket that's got a hole in the bottom. I mean, you're pouring money in, but it's leaking out way faster than you can fill it up. And this right here, this shows you the real-world damage. Back in 1980, the average home in the U.S. was about $47,000. Today, it's over $400,000. Your savings account, earning practically nothing, has absolutely zero chance of keeping up with that. This proves a critical point. You will never, ever save your way to being wealthy. It's just not possible. So, if just saving your money is the problem, what's the solution? Well, it's time to meet the most powerful force in all of finance and your new best friend, compounding. Think about it like this, okay? Saving is like going to the grocery store and buying lemons every single week. Investing is like buying one lemon seed. You plant that seed, you take care of it, and it grows into a tree that gives you its own lemons. Then you use the seeds from those lemons to plant more trees, and before you know it, you've got a whole orchard. You're not just a consumer anymore, you're an owner. Now, after 1 year of putting away just $10 a month, the difference is, well, it's $5. Big deal, right? And this is exactly why so many people just give up early on. It just doesn't look like much. It's so easy to say, what's the point? But fast forward 30 years. Just look at this. It's not even a fair fight. The saver, well, they've got a little over $3,600. The investor has almost $23,000. That huge gap isn't because they save more money. It's because they let their money go to work for them. That, my friends, is the magic of compounding. And this right here is the engine that makes it all happen. See, it's not a straight line where you just add a little bit each year. No, it's exponential. Your money earns interest, and then that new money starts earning its own interest. It's like a snowball rolling downhill that just gets bigger and bigger and bigger until it's an unstoppable force for building your wealth. Okay, I can hear what some of you are thinking. This all sounds great, but isn't this just like going to a casino? Isn't it just gambling? Let's just bust that myth right here and now, because honestly, it's the fear that keeps most people from ever getting started. The difference couldn't be more clear. They are worlds apart. Investing is all about ownership. You're buying a tiny piece of a real company that makes things or provides services. Gambling is just a bet on a random outcome where the odds are literally designed for you to lose over time. Investing is a long-term game of patience. Gambling is a short-term hunt for a quick thrill. And, unlike a casino where the house always wins, history is actually on the side of the investor. For almost 100 years, through wars, recessions, you name it, the stock market has averaged a return of about 10% per year. It rewards patience. It rewards consistency. It does not reward luck. So, if investing isn't gambling, that means there's a strategy to it, right? A way you can manage risk while you grow your money. So let's talk about the simple, powerful defensive plays that every single new investor should have in their playbook. Think about building your investment portfolio kind of like you're packing a fruit basket. You wouldn't just fill it with apples, would you? No, you want to mix some apples, some oranges, some bananas. Same idea here. You want a mix of different things, like stocks for that growth potential, and maybe some bonds for stability. This mix and match approach is called diversification, and it's your #1 defense. It's as simple as don't put all your eggs in one basket.
And here's what that might actually look like. A really common modern approach is a simple 80-20 split. 80% in stocks to capture that growth, and 20% in bonds to act as a stabilizer. It's designed to give you that upside potential of the market while having an anchor that kind of smooths out the bumps along the way. It's simple, it's effective, and it's easy to manage.
So the whole winning strategy really just boils down to this. Be the tortoise from the old fable. Step 1, diversify your assets so you're not all in on one thing. And step 2, play the long game. The goal isn't to get rich quick, it's to build wealth steadily and surely over time. I'm telling you, slow and steady absolutely wins this race.
Which brings us to our last and, honestly, our most important point of the day. When it comes to investing, your most valuable asset, it isn't how much money you have, it's how much time you have. And the cost of just waiting, it is absolutely staggering. Let's just look at a real-world example. Let's meet investor A. She starts investing at age 30, and she just puts away $100 a month. By the time she's 60, she's put in a total of $36,000 of her own money. But thanks to that magic of compounding, her portfolio is now worth over $228,000. A fantastic result. Now watch what happens. Here's investor B. He does the exact same thing, $100 a month, but he waits just 10 years to get started at age 40. By age 60, he's only invested $12,000 less of his own money. But look at his final balance, just over $76,000. That 10-year delay cost him over $150,000. And that's really the question that we end on. That decade of waiting is the single most expensive financial mistake that so many of us will ever make. The ideas we talked about are simple, the tools are out there, and the power of time is undeniable. So yeah, the best time to plant your lemon tree was 10 years ago, but the second best time? That's today. So the only real question left is, when will you start? All right, welcome. Today, we're basically grabbing our hard hats and tool belts because we are going to lay the foundation for building real, lasting wealth. And look, it all starts with knowing your materials. That means understanding your investments. This is, without a doubt, the absolute first step to becoming a smart, confident builder of your own financial future. So let's get into it. You know, this quote right here, this is pretty much our guiding principle for today. It's just so fundamental, isn't it? I mean, a painter has to know their brushes and their paints. A gardener, they've got to understand soil and sunlight. And for us, as financial builders, well, we have to know our tools. We absolutely need to understand what it is we're using to construct our financial lives. So here's the blueprint for today. First, we'll start by understanding our basic materials. Then we're going to cover the big three: stocks, bonds, and funds. Think of those as the foundation and the frame of our financial house. After that, we'll look at some other options. You know, the stuff you might use to furnish that house. And then finally, we'll talk about how to put it all together.
Okay, so before we can even think about building anything, we gotta know what our materials are even made of. And that starts with a word you hear thrown around all the time, but maybe it's never been crystal clear: a security.
Let's just cut through all the jargon, okay? A security is simply a financial asset you can trade. That's it. But the key, the really important part, is understanding the different types. Think of it this way. Equities mean you own a piece of something, like a stock. Debts mean you've loaned money to something, like a bond. This is the fundamental split in the entire world of investing: owning versus loaning. I'm telling you, once you truly get that, everything else just starts to click into place. All right, let's get to the heavy hitters. We're starting with stocks. And if we're building a house here, stocks are the structural frame. They provide the potential for height, for real expansion. They really are the primary engine for long-term growth in your portfolio. In the simplest terms possible, buying a stock just means you're buying a tiny piece of a company. You actually become a part owner, what they call a shareholder. It means you have a real legal claim on that company's stuff and its future earnings. And you know, that ownership can come with some pretty cool perks, like the right to vote on certain company decisions, and in some cases, you even get a cut of the profits, which we call dividends. Now, what I find really fascinating here is that this whole idea, it isn't some new, complicated thing. It actually goes all the way back to the 1600s. Say ship owners needed cash for these super risky voyages to the East Indies. We're talking pirates, terrible weather, no GPS, the whole shebang. So what did they do? They sold shares in a single voyage. If the ship made it back loaded with spices, the investors got a cut. And eventually, this evolved into a permanent stock in the entire company, meaning owners got a piece of the profits from all future voyages. The basic idea is exactly the same today. We've just swapped ships for companies and, well, physical paper for digital trades on the New York Stock Exchange.
So, how do you even begin to pick a stock? I know it can feel totally overwhelming, but you can start with just a few key steps. First, check out the market cap. That's just the total value of the whole company. A bigger cap, like an Apple or a Microsoft, usually means it's more established and probably less risky. Second, there's the PE ratio. This helps you figure out if a stock's price is high or low compared to what it's earning. And third, you gotta do a little digging into its financial health by looking at things like the annual report. You don't have to be a Wall Street genius, but you do need to do a little bit of homework.
So what's the bottom line with stocks? Well, it really comes down to a trade-off. On the one hand, you've got the potential for the highest returns over the long run. I mean, the real chance to grow your money and be a part of a company's success story. But on the other side of that coin, that potential for reward comes with higher risk, more volatility, more ups and downs, and the very real possibility of losing money. It's that classic risk-reward balance, plain and simple.
Okay, let's move on to our next big building block and see how this all fits together. If stocks are the frame of our house, then bonds, well, bonds are the solid, concrete foundation. They aren't designed for spectacular, shoot-for-the-moon growth. They're designed for stability and predictability. Hey, remember that whole owning versus loaning thing we talked about? Well, this is the other side. When you buy a bond, you are not buying ownership in anything. You are just lending money. Whether it's to a government or a massive corporation, you are playing the role of the bank. And in return for that loan, they promise to pay you regular interest, and then, at the very end of the term, they give you your original money back.
Now, not all bonds are created equal, that's for sure. You've got government bonds, like U.S. Treasuries, which are considered incredibly low risk because, well, they're backed by the government's ability to collect taxes. Then you've got corporate bonds. Here you're lending to a company, so the risk really depends on how financially healthy that company is. And to make up for that extra risk, they almost always offer a higher interest rate.
This quote right here highlights the single most important concept you need to know about bonds. Prices and interest rates move in opposite directions. Just think about it for a second. If you own a bond that pays you 3% interest, and all of a sudden new bonds are being sold that pay 5%, who in their right mind would want to buy your 3% bond for full price? Nobody. Its value on the open market has to go down to compete. This inverse relationship is exactly why a lot of people just buy bonds and hold them until they mature. That way, they get their original investment back without having to worry about all those price swings.
Okay, so we've covered stocks and bonds. Those are the individual bricks and planks of our financial house. Now let's move on to funds. The best way to think about a fund is like a prefab kit. It's a way to get a professionally designed, highly diversified structure all in one simple package. It saves you all the work of having to pick every single little piece yourself.
The world of funds really boils down to this one crucial distinction. On one side, you've got actively managed funds. This is where a person, a fund manager, is getting paid a very handsome salary to pick stocks they think are going to beat the market. And this costs a lot in fees. But on the other side, you've got passively managed funds. These don't even try to beat the market. They just aim to be the market by automatically tracking an index like the S&P 500. With no human picker, the fees are dramatically lower.
So, which approach actually works better? Do those highly paid active managers really earn their keep? Well, here's the punchline. Over a 15-year period, fewer than 8% of them, we're talking the pros, actually managed to do better than a simple, low-cost index fund that just tracked the market average. Let that sink in. Less than 1 in 10.
This incredible insight came from a guy named John Bogle, the founder of Vanguard. He just studied the data and came up with this revolutionary theory. Why on earth would you pay high fees for someone to try, and usually fail, to beat the market, when you could just buy the whole market for next to nothing? And this simple idea, it led to the creation of the very first index fund for the public, and I'm telling you, it completely changed the game for regular investors forever.
And Bogle's great idea just kept evolving. Today, the two most popular ways to invest passively are with index mutual funds and exchange-traded funds, or ETFs. The main difference is just how they trade. A mutual fund's price is set only once a day after the market closes. An ETF, though, it trades all day long, just like a regular stock. And that innovation made passive investing even more flexible and accessible for literally everyone.
All right, the foundation is poured, the frame is up, the walls are on. Now it's kind of time to furnish the place. These runner-up assets are a lot more specialized. You don't necessarily need all of them, but they can serve very specific purposes. So let's do a quick tour of the furniture store here. First up, CDs, certificates of deposit. Think of these as a savings account with a time lock on it. You agree to leave your money untouched for a set amount of time, and in return, the bank gives you a higher fixed interest rate. It's very safe, but it's not flexible. Next, we've got REITs. This lets you invest in a whole portfolio of real estate, like office buildings or apartment complexes, and you can collect income from it, all without the headaches of actually being a landlord. And finally, crypto. This is decentralized digital currency. It is a highly speculative asset. The potential for growth can be absolutely enormous, but it comes with extreme volatility and risk. And I have to give a very important word of caution here. You've got to be really wary of complex insurance products like annuities that get sold as investments. They often have huge fees that just eat away at your returns. Options trading is incredibly complex. It is not for beginners. And with crypto, the volatility is just extreme. A good rule of thumb is to keep it to a very small slice of your overall portfolio, say 5% or less, and only invest an amount that you are fully prepared to lose.
So, we've toured the whole hardware store. We've looked at all the tools, all the materials. Now it's move-in day. It's time to bring this all back to you and figure out how you can actually use this knowledge.
And here's the crucial point. The key isn't finding some single, magical, best investment. That doesn't exist. The magic isn't in finding some secret stock pick. The real power comes from understanding these different building blocks: the growth engine of stocks, the stability of bonds, the instant diversification of funds, and then combining them in a way that is right for you, a way that fits your personal goals, your timeline, and your own comfort with risk.
So, we've laid out all the tools and the materials. You now understand what they are and what they're for. So the question that remains, it's a personal one. What kind of builder will you be? What will you build with them? The blueprint is now in your hands.
You know, a lot of people think successful investing is all about some hot stock tip or just getting plain lucky. But the truth? The most successful investors, they don't rely on luck. They rely on a plan, a blueprint that's built just for them, for their financial future. And in this explainer, we're going to walk through exactly how you can build your own. And really, that's the whole ballgame right there. This isn't just about numbers on a spreadsheet. Investing is a tool, a powerful one, to help you build the life you actually want. This quote from our source material really sets the stage perfectly. Your money and your life's biggest goals, they should be moving in the same direction. So how do we actually build this blueprint? Well, we've got a clear step-by-step path to follow. First up, we'll get a handle on what makes an investor profile so personal. Then, we're going to define your goals, map out your timeline, figure out your comfort level with risk, and finally, pick a management style that works for you. All right, let's jump in. To start off, we've got to get one thing straight. There is no one-size-fits-all strategy in investing. It just doesn't exist. Everyone's profile is different because, well, everyone's life is different. And the source we're digging into today really highlights some specific factors that can shape your unique blueprint. And you know, one of the really powerful insights from the source is its focus on the unique financial factors that women in particular often navigate. Things like on average living longer, which means retirement savings have to stretch out over more years, or experiencing career interruptions for caregiving. Now, recognizing these realities isn't about limitations at all. It's about being smarter and building a more resilient financial plan right from the get-go. Understanding those personal factors leads us perfectly into the very first pillar of your profile, your financial goals. This is the foundation, the absolute first step. Because before you can even think about how to invest, you have to get crystal clear on why you're doing it in the first place. What are you actually working toward? Our source material makes this really easy by breaking goals down into 3 main buckets, all based on time. You've got your short-term goals, things you want to hit in the next year or two, then your medium-term goals for the next 3 to 10 years, and finally the big ones, the long-term ambitions that are more than a decade down the road. To make all of this a bit more real, let's follow a case study from our source. Let's meet Sarah. She's 30, works as a data analyst, and she's decided it's time to get serious about building her financial future. We're going to use her story to see how all these concepts play out in the real world.
So the first thing Sarah does is just take stock of everything. She looks at her life and sorts her finances into 3 simple categories. Needs, these are the absolute must-pays. Wants, the fun stuff that makes life worth living, and future, which is where her savings and investments stand right now. Honestly, this is a fantastic starting point for anyone.
Okay, once she has that snapshot, she starts setting some short-term goals. And notice how these are real, tangible wins she can actually achieve in the next couple of years. Paying off that high-interest debt, building up an emergency fund. These steps aren't just smart money moves. They build confidence, they build momentum. All right, next up are her medium-term goals. As you can see, these are getting bigger, a little more complex. A down payment for a house, paying off those student loans. These goals need a longer planning period and a much more structured approach to saving and investing.
And finally, we get to her long-term goals. This is the end game. $1 million for retirement, paying off the mortgage completely. For these huge ambitions, investing isn't just an option, it's an absolute necessity. This is where the magic of time and compound interest become your two best friends.
And here is the key connection, the aha moment. Once you have your goals all laid out, you've automatically figured out your time horizons. Let's look at how that builds the next critical piece of our blueprint. Because knowing when you need the money, that's what's going to determine your entire investment strategy. So, what is a time horizon exactly? It's really simple. It's just the amount of time you plan to keep your money invested before you need to pull it out and use it. And the most important takeaway here is this. A longer time horizon usually means you can afford to take on more risk because you have more time to bounce back from any market bumps in the road. This example from our source material just nails it. Take a look at these two sisters. Hina, she's 35 and she's saving for retirement in 30 years. That long time horizon means she can really focus on growth, on things like stocks. But her sister, Manur, she needs money for her daughter's college in just 7 years. Her much shorter, medium-term horizon means she needs a safer strategy, one that preserves her money. Same family, two totally different blueprints. This brings us to the third piece, and honestly, it might be the most personal part of the entire profile. Figuring out your risk tolerance. This is all about the how, the psychology of investing. It's about being really honest with yourself about how you'd feel when the market inevitably goes up and down. Simply put, your risk tolerance is your gut-level comfort with the idea that your investments could lose value. And listen, there is no right or wrong answer here. Some people are totally fine with big swings for the chance at big returns. Other people would much rather sleep soundly at night, knowing their money is in safer, slower-growing investments. You know, I love this next point from our source. It offers a fantastic reframing of a common stereotype. It suggests that women are often labeled risk-averse when a much better term might be risk-aware. And what that means is a tendency to do the research, to make calculated, calm decisions instead of emotional ones. And in a volatile market, that is a huge, huge advantage. Okay, so let's make this practical. Think about this for yourself. How much of a temporary drop in your investments could you stomach? If your portfolio went down 10%, would you get nervous? What about 30% or even 50%? Be honest, your gut reaction to that question tells you a lot about your personal risk tolerance. Here's another way to think about it. When it comes to investing, are you playing offense or are you playing defense? Is your number one goal to hit a home run by maximizing your returns, even if that means striking out sometimes? Or is your main focus to protect what you have and minimize any potential losses? So, we've defined our why, our when, and our how. Now we're at the final, very practical decision in building your investor profile, choosing your management style. This is all about how involved you actually want to be in the day-to-day. Really, it boils down to two main approaches. Active management is hands-on. You're the one doing the research, buying and selling, trying to beat the market. Passive management is the opposite. It's more of a set-it-and-forget-it strategy. You buy broad market funds, think S&P 500 index funds, and you just let them do their thing for the long haul. And if you're wondering which approach tends to work out better, well, check out this number. A well-known study cited in our source found that over a 20-year period, the average active investor earned about $120,000 less than a passive investor who just bought and held an S&P 500 index fund. And why is that? It's usually two things. Higher fees eat away at your returns, and trying to time the market perfectly is just incredibly difficult. For most people, being more hands-off actually leads to better results. So let's put it all together. Let's recap the whole blueprint. It's a simple 4-step process. Step 1, define your goals. That's your why. Step 2, map your time horizon. That's your when. Step 3, gauge your risk tolerance. That's your how. And step 4, choose your management style. That's your action. That's it. That's your personal blueprint.
Just remember, this blueprint isn't something you carve in stone. It's a living document. It's going to change and evolve as your life changes. The most important thing is to just get started. So, after everything we've talked about today, what's the very first goal you are going to build a plan for?
All right, let's just jump right in. You know that term investment portfolio? It can sound a little intense, right? Kind of like something you need a fancy degree to even think about. Well, we are about to completely demystify it. I promise, by the end of this, you'll see that this stuff isn't just for Wall Street pros. It's for you. We're going to lay out a simple step-by-step roadmap to get you from just saving cash to actually making your money work for you.
And hey, let me be crystal clear. Saving money is absolutely 100% crucial. It's the bedrock. It's your safety net, right? That emergency fund that lets you actually sleep at night. Without a solid savings foundation, everything else we're about to talk about is just built on sand.
But, and this is a big but, if you want to do more than just get by, if you're serious about building real, lasting wealth for your future, you've got to put that money to work. It's the difference between treading water just to stay afloat and actually swimming toward your destination. And that difference, that leap, well, that's investing.
So here's our game plan. It's pretty straightforward. First, we'll walk through opening the right kind of account. Then, we'll figure out a simple strategy that works for you. After that, the big moment, actually clicking buy. From there, we'll get into the really smart stuff, like how to manage costs and avoid risks. And we'll wrap it all up with what might be the most important part, having the right mindset to play the long game.
Okay, first things first. Step 1. You can't just buy stocks from your regular old checking account. You need a specific place for your investments to live and hopefully grow. And that place is called a brokerage account. Think of it as a special vault just for your stocks and funds.
I really love this airline analogy because it makes so much sense. You've basically got two options here. You've got your full-service brokers. That's the first-class ticket. They do everything for you, but man, you pay for that luxury. We're talking 1 to 2% of everything you have with them every single year. For most of us, especially starting out, the discount broker is the way to go. It's like flying premium economy. You're in charge, you're the pilot, but the costs are incredibly low, sometimes even zero. So when you're shopping around, this checklist right here is going to be your best friend. A few things are just non-negotiable. First, no commissions, period. You should not have to pay a fee just to buy or sell. Make sure they actually offer what you want to invest in. The platform itself should be easy to use. If the app is a nightmare, you're just not going to use it. And here's a pro tip. Actually call their customer service number before you sign up. See how long it takes to get a real human on the phone. And of course, do a quick Google search. The company's reputation speaks volumes.
Now, hang on. Before you go and dump all your money into that new brokerage account, we need to talk about the smartest way to do this to save on taxes. There's an order to it. And number one, first and foremost, if your job offers a 401k match, you contribute enough to get every last cent of that match. It's an immediate 100% return on your money. It is literally free money. Do not leave it on the table. After that, an IRA is usually your next stop. Once you've taken care of those tax-advantaged accounts, then you can start pouring money into your individual brokerage account.
All right, so the account is open. Now we get to the fun part. But wait a second. Before you just start clicking buy on random things, you need a plan, a blueprint. Your investment strategy is basically your North Star. It's what's going to keep you calm and on track when the market inevitably goes on one of its wild roller coaster rides. Now, if you decide you want to get some help from a financial professional, there is one word that is your ultimate shield: fiduciary. Memorize it. It's a legal requirement that means they have to act in your best financial interest. It's like a doctor having to prescribe the best medicine, not just the one that a drug company pays them to push. The alternative is something called a suitability standard, which is way weaker. That's more like selling you a shoe that fits, but isn't necessarily the best one for you, maybe because they get a bigger commission. So you always have to ask, are you a fiduciary?
And Warren Buffett just nails it with this quote. It sums up the problem perfectly. If the person giving you advice makes more money by selling you one thing over another, which one do you think they're going to recommend? It's a built-in conflict of interest, and it's exactly why you either need to learn this stuff for yourself or only work with advisors who are fee-only fiduciaries. So what do these strategies actually look like? Well, here are a few of the big ones. But honestly, for anyone starting out, dollar cost averaging is pure gold. It's so simple and so powerful. You just invest the same amount of money on the same day every single month. That's it. Market's up, you buy. Market's down, you buy. It takes all the emotion and the guesswork out of the equation.
And it's just magic when you combine that with a simple, broad market fund.
Okay, you've done all the prep work. Your account is funded. Your strategy is in place. Now comes the single most important part of this whole thing. This is the moment where all that planning becomes real.
It is so easy to get stuck right here. They call it analysis paralysis. You can read 100 books, watch 1,000 videos, build the world's most perfect spreadsheet, and all that research, it feels productive, right? But really, it can just be a really clever way of procrastinating.
So here it is. The one thing that actually separates a saver from an investor is hitting that buy button. That's the whole game. It's the leap of faith. You've probably heard this a million times, but it is so true. Time in the market always beats trying to time the market. Every single day you wait on the sidelines is a day of potential growth that you can never, ever get back.
So when you go to make that first purchase, you're going to see two main options. A market buy is the easy one. You're basically saying, just get me in, I want to buy this right now at whatever the current price is. For the kind of long-term regular investing we're talking about, this is usually all you'll ever need. A limit buy is a little more tactical. You're saying, hey, I only want to buy if the price drops to this specific number or lower. It gives you more control for sure, but there's a catch. The price might never drop that low, and your order might never go through.
You did it! You're an investor. Congratulations. Now, let's talk about how to play the game smartly. Because long-term success isn't just about picking the right things. It's also about what you manage to keep. And that means keeping your costs low and knowing how to spot and avoid unnecessary risks.
So with any investment fund, you're going to see something called an expense ratio. It's a tiny little fee. With a good low-cost index fund, you might see a number this low, 0.05%. It looks like nothing, right? But let's actually break down what that tiny number means for your wallet. What it means is that for every $10,000 you have invested, the total fee for the entire year is $5. That's it. This is the secret weapon of low-cost investing. Every single dollar you don't pay in fees is a dollar that gets to stay in your account, working for you, and compounding over and over year after year.
And on the risk side of things, you have got to be your own security guard. Keep your antenna up for these huge red flags. If anyone ever promises you guaranteed high returns with no risk, they are lying to you. If you feel that high-pressure sales tactic, that you have to act now or you'll miss out, that's a scam. Real investments don't need that kind of hard sell. If something feels off in your gut, it probably is. You have to trust that feeling.
So we've covered the mechanics, the nuts and bolts. But for this last part, let's talk about the single most powerful tool you have as an investor. And that's your mindset. Because I guarantee you, the market is going to test you. It will go up, it will go down. And your ability to stay calm and stick to your plan when things get scary, that is the number one thing that will determine your success in the long run. Let's make this real for a second. Go back to the 2008 financial crisis. From its peak to its bottom, the S&P 500 fell over 50%. Just try to imagine that. You open up your account statement and half of your life savings is gone. The fear was real. Millions and millions of people panicked, they hit the eject button and sold everything at the absolute worst possible time.
But then there were the other investors, the ones who understood that this is just what markets do sometimes, that a crash is a feature of the system, not a bug. They held on tight, they gritted their teeth, maybe they even kept buying more, and they just stuck to their original plan. And that patience was about to pay off in a massive way. And here's the payoff. In the 10 years after that market bottom in 2009, the S&P 500 just roared back, delivering an average annual return of over 17%. Just think about that. The people who panicked locked in their losses permanently. But the ones who stayed put, they not only got all their money back, but they rode one of the greatest bull markets in history.
So what's the big takeaway here? Investing isn't about getting rich quick. It's not a lottery ticket. It's a marathon. It's built on discipline, on patience, and on consistency over years and decades. We've laid out the entire roadmap for you, from start to finish. The only thing left to do now is take that first step. So are you ready?
Let's be honest. You want to make sure you've got enough money to retire someday. I mean, that's the dream, right? But maybe you don't want to spend all your free time trying to become some kind of stock market genius to make it happen. So what if I told you there's a way to put your entire retirement savings plan on, well, full autopilot? So let's just ask it straight up.
Do you want to build a solid future for yourself without having to get a degree in finance? If you're sitting there nodding, you are in the right place. Because today, we're going to talk about the single best tool for set it and forget it, retirement investing.
All right, let's meet the star of the show, the Target Date Fund, or TDF for short. And you should really just think of it by its nickname, the Full Autopilot Portfolio. It's this all-in-one investment fund that's built to do all the heavy lifting for you, from picking the right investments to managing your risk, all the way up to the day you decide to retire.
So is this for you? Well, if you're the kind of person who loves the idea of a self-driving car, if you want the financial results of investing without all the work, and if you're totally comfortable handing over the controls to a system that's designed to play it safe in the long run, then yeah, you might just be a full autopilot investor.
Okay, so if you're going to trust the autopilot, you got to know how it works, right? So let's pop the hood on this retirement vehicle and see what's really making it run.
You know, it's actually pretty simple. This autopilot system has two main jobs. First, it acts like your own personal investment shopper, picking out a really wide mix of investments for you. And second, and this is the really magical part, it automatically adjusts that mix over time, getting safer and safer as you get closer to retirement.
Okay, check this out. Let's imagine this is you in your 30s. The fund literally has its foot on the gas pedal. You can see it's almost all in stocks. Those are your engine for growth. Why? Because you've got decades ahead of you, plenty of time for that money to grow and to bounce back from any bumps in the market.
Now, let's jump forward a few decades. You're getting close to your destination, retirement. The fund knows this, and it has automatically started to ease off the gas and apply the brakes. It's moved a huge chunk of your money out of those aggressive stocks and into safer, more stable bonds, all to protect the money you've already made.
And this super smart automatic shift from aggressive to conservative, it actually has a name. It's called the glide path. Seriously, think of it like an airplane that's smoothly descending for a perfect landing. The Target Date Fund is designed to give your money that same smooth, automated landing into retirement, and you never have to touch a single control.
So, what are the upsides here? I mean, what makes this set it and forget it approach such a smooth ride for so many people?
Well, for starters, it is unbelievably easy. You just pick the fund with the year you think you'll retire. That's it. You're done. Second, it's a one-stop shop for diversification. You buy this one fund, but inside it, you own thousands of different investments. Third, and this is maybe the biggest benefit, it protects you from yourself. It stops you from making that classic mistake of panic selling when the market gets a little crazy. And look, for people who value their time, paying a small fee for all that convenience, that can be an absolutely fantastic trade-off.
But just like any fancy feature in a car, autopilot isn't always free. When you hand over control, there are some trade-offs, and it's really important to understand exactly what you're paying for all this convenience. I love how the source material puts this. Cruise control usually isn't free. That awesome ability to just sit back and relax, it comes with a price tag. In the investing world, that price is called an expense ratio. It's just a small annual fee you pay the fund manager for doing all the work for you. And this chart really shows you what that cost looks like. A typical target date fund might charge you around 0.75% per year. But if you are willing to build a similar portfolio yourself, just by buying a few simple low-cost funds, your total fee could be as low as 0.11%. Now that looks like a tiny difference on paper, but let's see what that means in actual dollars. So this is where it gets real. On a portfolio of $100,000, that 0.75% fee costs you $750 every single year. The do-it-yourself approach, $110. That's over $600 a year that could have stayed in your account, growing for your future. And over 30 or 40 years of investing, that small difference can add up to tens, even hundreds of thousands of dollars. The cost of convenience is a big deal.
All right, there's another potential downside to think about. The robot that's driving your investments, well, it might be a lot more boring, a lot more conservative than you are, especially as you get older.
Some interesting research from places like MIT suggests that these funds might get too safe too soon. See, by the time you retire, they often cut your stock holdings way down, sometimes to 40% or even less. But that same research suggests that for a lot of people, staying at around 60% stocks would actually be better for long-term growth even after you've retired. And that really gets to the final issue. A target date fund is a one-size-fits-all solution. But we're not all the same size, are we? It doesn't know you. It doesn't know your personal comfort level with risk or your other sources of income, or if you have any special interests, like only wanting to invest in sustainable companies. It's a generic plan.
Okay, so you've heard the good, you've heard the bad, and you have decided, yep, autopilot is for me. Awesome. Now let's talk about how to turn it on the right way, and this is just as important, what common mistakes you've got to avoid.
The great news is, this part couldn't be easier. Step 1, log into your retirement account, your 401k, your IRA, whatever it is. Step 2, look for funds with names like Target Date Fund. Step 3, pick the one with the year closest to when you want to retire, maybe something like Target Date 2050. And Step 4, put 100% of your investment into that one fund. That's it. You're done. Your retirement investing is now officially on autopilot.
But you got to watch out for these common driver errors. First, don't let automation turn into apathy. The fund is smart, but it can't decide how much you should be saving. That's still up to you. Second, trust the system. Don't try to help it by buying a bunch of other stocks and funds. It's already diversified for you. And finally, don't freak out when the market goes up and down. You chose autopilot for a reason, so let it do the driving.
This quote from the source material is just perfect. Worrying about your target date fund is like plugging your destination into Google Maps and then making your own right and left turns. I mean, think about that. You wouldn't do it in your car, right? You have to let the system do its job. You have to let it navigate.
So at the end of the day, it all boils down to this one simple choice. On one side, you have the target date fund. You pay a little more in fees for the incredible convenience of full automation, but you give up some control. On the other side, you have the do-it-yourself approach. You get much lower fees and total customization, but you and only you have to do all the work.
Look, there is no single right answer here. There's only the answer that's right for you. So the only question left to ask is the one you got to ask yourself. When it comes to your own financial future, which driver's seat do you belong in?
All right, let's talk about getting rich. We're all told it's got to be complicated, right? That you need to be glued to the markets, making brilliant moves, constantly tweaking your portfolio. But what if I told you the real secret was to just do less? Today, we're diving into a really powerful idea called the lazy luxury, and it completely flips that old script on its head.
I know, it sounds almost ridiculous, doesn't it? The idea that being lazy could actually make you more money. It goes against everything we're taught about hard work. But as you're about to see, when it comes to investing your money for the long haul, a set-it-and-forget-it mindset isn't just easier, it can be way, way more effective.
So here's our game plan. First, we're going to bust the myth that investing has to be complex. Then we'll look at the ultimate proof from Warren Buffett himself. You're going to love this story. After that, we'll get into the nitty-gritty of the one simple fund you can use, weigh out the good and the bad, and finally, help you figure out if this lazy approach is your ticket to financial freedom.
Okay, let's get right into it. We need to tackle this idea that a more complicated investment strategy is somehow a better one, because frankly, it's a myth. You've all heard this saying, right? Well, this is the absolute soul of the lazy luxury philosophy. The smart investor here doesn't waste their precious time trying to pick the next hot stock or build some perfectly balanced 17-fund portfolio. No. Instead, they pick one great simple investment and then they focus all their energy on what actually moves the needle, earning more money so they can invest more money. The idea is to make the process of investing boring so your long-term returns can be exciting.
Now, I know what you might be thinking. This sounds a little too good to be true, and I get it, but we have the ultimate case study, the ultimate piece of evidence, and it comes from one of the greatest investors who ever lived. Picture this, January 1st, 2008. Warren Buffett publicly throws down $1 million gauntlet. In one corner, you've got Buffett betting on a dead simple, low-cost S&P 500 index fund, the poster child for lazy investing. And in the other corner, you have Ted Sides, a hedge fund manager, betting that a hand-picked basket of super sophisticated, actively managed hedge funds run by the Wall Street geniuses would crush the simple fund. It was the ultimate showdown, simplicity versus complexity.
So how did it play out? Well, the bet was supposed to last for 10 years, but here's the kicker. By 2016, the simple S&P 500 fund was so far ahead, it was a total blowout. Ted Saidas actually surrendered, tapping out 2 years early. He literally wrote an article saying, "The game is over. I lost."
And when you look at these numbers, you can see why he threw in the towel. It wasn't even close. Over the course of the bet, Buffett's boring old index fund averaged a 7% return per year. And those high-fee, expertly managed hedge funds a pathetic 2.2%. This wasn't just a win for being lazy, it was an absolute knockout punch.
When all was said and done, that initial $1 million investment had ballooned to more than $2.2 million, and Buffett, being Buffett, donated it all to charity. This one single bet proves, without a shadow of a doubt, that a simple passive strategy isn't just a decent option, it can flat out dominate the so-called experts.
Okay, so the proof is in the pudding. We know this works. So now let's talk about the actual tools, the specific investments you can use to build your very own lazy luxury portfolio. The first and most famous option is an S&P 500 index fund. And the concept is just beautiful in its simplicity. When you buy into one of these, you're not trying to pick a winner. You're buying a tiny slice of the 500 biggest, most influential companies in America. You get instant diversification across tech, healthcare, finance, you name it, all in one shot. Lazy mode, fully engaged.
Now, the other really popular choice is a total stock market index fund. It's basically the S&P 500's slightly bigger cousin. As you can see, it holds all 500 of those big companies. That's about 80% of the fund, but then it also sprinkles in thousands of smaller and medium-sized companies, so you get even broader exposure to the entire U.S. economy.
So which one is better? Which one should you pick? Here's the secret. For a long-term investor, it barely matters. Seriously. Because the S&P 500 makes up such a massive part of the whole market anyway, their performance tracks each other incredibly closely. We're talking a difference of less than 0.5% on average over the last 30 years. You really truly cannot go wrong picking either one.
But look, no strategy is perfect for every single person. So let's be realistic here. We need to look at both sides of the coin, what you're giving up by doing this and what you're getting in return.
Let's start with the potential downsides, the bad stuff. First, you're going all in on Team USA. You have zero international stocks, which means if the US economy hits a rough patch while the rest of the world is booming, you're going to feel it. Second, your fate is kind of tied to the biggest companies. When Apple and Microsoft have a good year, so do you. When they have a bad one, well, you get the picture. And third, and this one's a biggie, this is a 100% stock portfolio. It's going to be a bumpy ride. You have to have the stomach for some pretty wild swings. Now, let's just double-click on that international argument for a second. Traditional financial advice screams that you need international funds for diversification. But if you just look at the history, over the last 3 decades, the S&P 500 has delivered about 10% a year on average. A major international index, closer to 5%. Now, of course, the past is no guarantee for the future. But a lazy luxury investor looks at this chart and says, you know what? For maximum growth, I'm sticking with the horse that has been winning the race.
Okay, now for the good stuff. And this is why this strategy is so compelling. Number one, it is dirt cheap. The fees on these index funds are microscopic. Number two, the performance. As we're about to see, this simple approach has historically wiped the floor with more balanced options. And finally, the sheer, beautiful simplicity of it all. You get amazing results with almost no effort.
And this chart just says it all. This comparison from Barron's is mind-blowing. Over 28 years, a common target date fund, one of those popular, more conservative choices, returned 750%. Not bad. But the S&P 500, it returned almost 1,500%. That is literally double the return for being just as lazy. That is the luxury part of this whole strategy.
So, we've covered the why, the how, the good, and the bad. Now we get to the most important question of all. Is this strategy actually right for you? Let's figure that out. This approach really shines for a specific kind of investor. First, you have to have a long time horizon. We're talking decades, not just a few years. Second, you need a high tolerance for risk. You have to be okay seeing your portfolio drop significantly and not lose sleep over it. And finally, you have to be committed to being passive. If you're the kind of person who likes to tinker and make changes, this is going to drive you crazy.
So if you decide this is for you, there are 3 critical mistakes you have to avoid. Number 1, resist the urge to do something. Your job is to do nothing. Disciplined inaction is the name of the game. Number 2, you have to be mentally ready for the crashes. When the market is tanking, you have to hold on for dear life and not sell. And number 3, this is not a forever portfolio. As you get closer to needing the money in retirement, it's absolutely crucial that you start shifting some of that money into more stable things, like bonds, to lock in your gains.
So here's the bottom line. The lazy luxury strategy gives you an incredibly powerful engine for building wealth. But with that great power comes a very unique responsibility.
the responsibility to do nothing. The real challenge isn't picking the fund, it's having the discipline to trust it, to ignore the noise, and to let this simple, proven strategy work its magic over decades. So the only question left is, are you ready to embrace it?
All right, let's dive in. We should probably talk about investing. You know, for a lot of us, the smart path, the right path, is the disciplined one. You put your money in index funds, use dollar cost averaging, you set it, and you forget it. And look, that's a fantastic strategy. But can we be honest for a second? Doesn't a little part of you just feel like you're missing out on all the action? I mean, you see these headlines, stocks soaring left and right. And yeah, your index fund is chugging along, doing its job, but it doesn't have that thrill, does it? If you've ever felt that little itch, trust me, you are not alone. It's a real feeling, and today we're going to talk about a strategy that lets you scratch that itch without betting the entire farm. So, to really get this, let's use an analogy. I want you to picture your favorite restaurant. You know the one. And you have your go-to dish, the one that never, ever lets you down. But every single time you open that menu, you see it, the special. It looks interesting. It could be absolutely amazing, or it could be a total disaster. Now, if you try something new every single time, that's just too risky. Eventually, you're going to order a dud and start questioning why you even like the place. So, what's the answer here? Well, you don't give up on your favorite meal, of course not. You stick with what you know works, but you get a little adventurous with the side dish. Maybe you try the risky asparagus. And you know what? If it's mushy, who cares? The main course was still fantastic. This, right here, is the exact philosophy behind what we call the fun money portfolio. And that is what this strategy is all about. It's about striking a perfect balance. It's designed to give you the rock-solid stability of your main course investment, while also giving you a small, designated side dish to play with, to experiment, and maybe, just maybe, to find a brand new favorite.
So, how do we actually set this up? Well, it's a really simple but incredibly powerful 90-10 split. The vast majority of your investment, 90%, that's your main course. It goes into a broad, super reliable index fund, like an S&P 500 or a total stock market fund. That's your foundation. Then, the other 10%? That's your side dish. That's your fun money that you get to use to invest in individual companies that you've researched and that you really, truly believe in.
Now, we gotta ask, who is this really for? Because it's not for everybody. This profile here tells the story. A fun money investor is in it for the long term, and this is the big one, their risk tolerance is way up there. Here's the way to think about it. A classic wooden roller coaster is boring to them. No, they want the loops, the corkscrews, the upside-down parts, because they know that's where you get the chance for those much, much bigger returns.
And the main game we're playing with that 10% is something called value investing. Put simply, you're becoming a bargain hunter. You're on the lookout for really solid companies that, for whatever reason, the market just isn't appreciating right now. You're trying to buy them for less than their intrinsic value. That's what the company is actually worth based on its real assets and earnings, not just the crazy price the market is slapping on it today. The whole point is to buy at a discount and then just wait until everyone else catches on.
Okay, so this all sounds pretty great, right? But before we get too carried away, we have to pump the brakes and talk about the flip side. Because more fun does not always mean more profit. When you take on this kind of risk, you're also taking on the real possibility of bigger losses. So let's get serious for a minute and talk about the bad stuff.
When you decide to do this, there are 3 really big mental traps you absolutely have to avoid. And the first one is just plain impatience. This is not a get-rich-quick scheme. Value investing takes an incredible amount of patience and discipline. You might find what you think is a hidden gem, but the rest of the world, they might not notice it for a very, very long time.
You know, the master of this whole thing, Warren Buffett, he famously said, our favorite holding period is forever. And that perfectly sums up the mindset you need. It can literally take years for the market to finally wake up and price a company correctly. And during all that time, your stock might do absolutely nothing, or worse, it might even go down. You have to have the guts and the conviction to wait it out.
Now, the second mental trap is thinking that strong fundamentals are a guarantee. Let's talk about a fallen giant, General Electric. For decades, GE was the literal definition of a blue-chip stock. It was stable, reliable, massive. It was considered a totally safe bet. With all its different businesses and what looked like an ironclad balance sheet, value investors absolutely loved it. Back in the 90s, early 2000s, it felt invincible.
But then came the 2008 financial crisis, followed by a whole series of terrible missteps. some bad acquisitions, too much exposure, and the stock just fell off a cliff. Today, it's just a shadow of what it once was. And that is such a powerful and humbling lesson. What looks like a rock-solid company today can absolutely crumble tomorrow.
And that leads us straight into our third risk, our third mental trap. Believing your crystal ball is always clear. You know, this quote here nails it. Just because the market gets it wrong all the time, that doesn't mean you're always going to get it right. Even with the best analysis in the world, you can't see the future. And sometimes, even worse, you're not even working with all the real information. Which brings me to Enron.
On paper, back in the 90s, Enron looked incredible. Amazing growth, fantastic reputation. But behind the scenes, the whole thing was a house of cards. It was built on just massive systemic accounting fraud. They were hiding billions in debt, completely fabricating financial records, lying about their profits, all while engaging in illegal insider trading. Tons of smart value investors got totally fooled, not because their research was bad, but because the numbers they were looking at were a complete lie.
Okay, enough for the doom and gloom. I know that was a little heavy, but it's so important that you understand the risks, because on the other side of all that risk is the potential for absolutely incredible rewards. So let's pivot. Let's talk about the good stuff.
After all of that, after all the warnings, what happens if your research actually pays off? What happens if you dig through all the noise and you find that one company before anybody else sees what you see, and you are 100% right about its potential? What if you could get a return that looks something like this? 200,000%. That is the actual total return of Monster Beverage Corporation's stock over the last 30 years. Yeah, that Monster Energy drink. It was the single best performing stock in the entire S&P 500 over that time. Let's make that number real for a second. Look at this. If you had put just $10,000 into that company back in the day, your investment today would be worth about $20 million. That is the kind of life-changing power we're talking about from getting just one pick right inside your small 10% fund portfolio.
So if you're sitting there thinking this balance of safety and high reward potential sounds interesting, let's get into the playbook. How do you actually put this thing into practice and get started the smart way?
So how do you build it? It's really just a simple 3-step process. Step 1, 90% of your investment money goes straight into that boring, reliable, broad index fund. Step 2, the other 10% is your ammunition to buy shares in those individual companies you've picked out. And step 3, here's a little pro tip. Make sure your brokerage offers fractional shares. That just means you can buy tiny pieces of a stock, which is perfect when you're only working with 10% of your portfolio. All right, let's talk about some common mistakes. Yeah, Warren Buffett says his favorite holding period is forever, but that comes with a giant asterisk. You can't just buy a stock and forget about it. A massive mistake people make is holding on for dear life long after a company's fundamental reason for existing has been destroyed.
Remember Blockbuster? It was a multi-billion-dollar behemoth, but then streaming came along and its entire business model became a relic overnight. Its intrinsic value literally went to zero. And any investor who held on just hoping for a comeback that was never going to happen, well, they lost everything. You have to know when it's time to cut your losses and walk away.
So here it is, your final playbook. 3 simple rules. First, do your homework. Please, dig way deeper than just the surface level numbers. Second, know when to abandon ship. We're calling this the Blockbuster rule. Don't cling to a stock if the company's core business is fundamentally broken. And third, stop chasing rockets that have already left the launch pad. Your job is to find the value before it skyrockets, not after.
And that all leaves us with one final and really important question. This 10%, it's your space to experiment, to have fun, and yeah, to potentially win really, really big. But it all hinges on your ability to spot what true value is. So the question I want to leave you with is this. Beyond all the numbers and the financial ratios, what does value truly mean to you as an investor?
You ever find yourself just completely frozen, trying to decide what to have for dinner? Tacos or pasta? It seems so simple, but that little bit of indecision can be genuinely stressful. Okay, now take that feeling and multiply it by, 1,000 when you're talking about your life savings. We're going to get into this today because we are tackling that exact feeling.
I mean, this is it, right? This is the classic tug of war for every investor.
In one corner, you've got the incredible, exciting potential for huge growth with stocks, and in the other, you have that warm, safe blanket of stability from bonds. It's a choice that can make you feel totally paralyzed.
And here are the two extremes, side by side. You go all in on stocks, yeah, you could see some amazing growth, but you're also strapping yourself into a pretty wild roller coaster that might just cost you your sanity. On the flip side, go all in on bonds, you'll definitely sleep like a baby, knowing your money's safe, but the returns, well, they might feel a little underwhelming. It feels like you have to pick one or the other.
And this dilemma, this is exactly where so many of us get stuck. But what if you didn't have to choose? What if there was a way to get a little bit of both?
Well, this brings us to a really elegant solution, the 50-50 split. Think of it like this. You're just ordering half tacos, half pasta. You really do get the best of both worlds. It's designed to be that just right option. You know, the Goldilocks portfolio. Not too hot, not too cold. It's all about balancing that growth engine of stocks with the steady, calming anchor of bonds.
So, let's dig into who this simple, powerful solution is actually for. I mean, is it right for you?
Take a look at this. Does any of it ring a bell? You're investing for a decent amount of time. You're okay with a little bit of risk, but you're not exactly a daredevil. You'd much rather set it and forget it than watch the market all day. And really, your main goal is just a nice, happy balance between seeing your money grow and being able to sleep at night. If you're nodding along right now, you just might be a 50-50 investor.
Let me ask you a question, just to frame this idea of risk. Picture this. You're booking a flight. You have two options. One is $100, but there's a good chance it's going to be a really bumpy ride. The other is $300, but it promises a super smooth, comfortable journey. Which one do you pick? There's really no wrong answer here, but your gut reaction says a whole lot about how you feel about risk.
And you know, if you found yourself leaning toward that more expensive, smoother flight, then you already get the philosophy behind the 50-50 split. You might leave some money on the table, that's the price you pay, but what you get in return is a less stressful, more comfortable financial ride. And for a lot of people, that peace of mind is, well, it's priceless. But getting there means we have to be brutally honest about what you're giving up.
So, let's be real for a minute. No investment strategy is perfect, and it is absolutely crucial that you understand the trade-offs. Before we get to all the good stuff, we have to take a hard look at the potential downsides of putting half your money into bonds.
And this chart, wow, this chart really spells it out, doesn't it? This is the biggest trade-off, long-term growth. So if you'd put $20,000 into an S&P 500 fund back in '91, it would have grown to around $400,000. That same 20 grand in a bond fund, about 100,000. That is a massive, massive difference. And it really hammers home the point that stability from bonds comes at a very real cost.
Okay, and here's another really important risk. And honestly, this is something that confuses a lot of people. There is a huge difference between buying a single individual bond and investing in a bond fund. With an individual bond, you get a fixed, predictable payment, the coupon, and you get your exact investment back on a specific date. Simple. But a bond fund, that's a different animal. It pays a variable amount, and since it never matures, the value of your initial investment can go up and down. You lose that predictability.
And there are two other big ones you got to keep an eye on. First is interest rate risk. All that means is when new bonds come out paying higher interest, your older, lower-paying bonds suddenly look less attractive, so their value on the market drops. And then there's inflation risk. You know, if inflation is chugging along at 3%, but your bond is only paying you 2%, you're actually losing buying power. Your money is kinda sorta on fire.
Okay, so we did the reality check, we looked at the tough stuff. Now let's talk about why, for the right person, making those trade-offs is absolutely worth it. It's time to talk about the huge benefits of having that balance.
This right here, this is where the 50-50 portfolio puts on its superhero cape. Just look at what happened back in the 2008 financial crisis. The S&P 500 just fell off a cliff. It dropped over 50%. But bonds? They held steady. Some even went up. A 50-50 portfolio still went down, sure, but that bond half acted like a giant shock absorber. And this is more than just about numbers on a page. It's an emotional buffer. It helps stop you from making the single worst mistake any investor can make, panic selling at the absolute bottom.
Ooh, I love this analogy for explaining how an individual bond works. It's like getting a shopping cart at Aldi. You put a quarter in, that's your investment. You use the cart, and then, when you're done, you bring the cart back and you get your exact quarter back. It's a guarantee. The only difference is, with a bond, it's like the store pays you interest while you're shopping. It's just a simple, powerful concept.
And you know, beyond just being stable, bonds are fantastic for creating cash flow. That steady stream of interest payments creates a reliable income you can actually plan your life around. For anyone who's in retirement or even just getting close, that predictability isn't just a nice little perk, it is absolutely essential.
Let's put some real numbers to that. Say you have $100,000 in a bond fund that yields 3%. That could generate about $3,000 a year in income. That's real cash you can use without having to sell off your core investments. You can see how, as your nest egg gets bigger, this becomes a really powerful way to fund your life.
All right, so you've heard the pros, you've heard the cons, and you're thinking, yeah, this balanced approach, this sounds like me. Well, the best part is building it is actually incredibly simple. Let's walk through exactly how to do it.
I mean, it's right there in the name, right? You take your money, you split it straight down the middle. 50% goes into a big, low-cost stock market index fund. That's for your growth. The other 50% goes into high-quality bonds, either through a fund or by buying them one by one. That's it. It really is that simple.
So what do I mean when I say high quality? We're talking about the safest stuff out there. Things like U.S. Treasuries, which are backed by the full power of the U.S. government. It just doesn't get much safer. Then you've got investment-grade bonds from huge, stable companies and municipal bonds from states and cities. This is the solid foundation for the stable half of your portfolio.
Now here is a very common trap you've got to avoid. You're going to see so-called high-yield or junk bonds, and they'll be offering these really tempting high interest rates. But chasing those, it's like eating only the frosting on a cake. It totally misses the point. The whole reason you have bonds in this portfolio is for safety. Junk bonds act more like stocks, and they tend to get crushed in a downturn, which completely defeats their purpose as your safety net.
And what about that inflation risk we talked about a minute ago? Well, you don't just have to sit there and let it eat away at your returns. There are tools specifically designed to fight back. Two fantastic examples are government bonds called I-bonds and TIPS. They are literally built to protect your money's buying power when inflation gets hot, making sure your real return stays positive.
At the end of the day, it really all comes down to this one simple but incredibly profound truth. There is no one-size-fits-all answer in investing. What works for your buddy or some guru you see on TV, it might not be what lets you rest your head on the pillow at night and actually sleep. The right portfolio is the one that fits you.
So I'll just leave you with this one question to think about. The 50-50 split is all about a trade-off. You accept that you might get lower returns in exchange for a much smoother ride and a lot less stress. So you just have to ask yourself, on your financial journey, what's the right price to pay for a good night's sleep?
All right, let's talk about something that probably keeps a lot of us up at night: retirement. And more specifically, how to make sure our money lasts. We're going to dive into a pretty powerful strategy today, one that's all about creating an income stream that doesn't just sit there, it actually grows. Think of it like giving yourself a raise every single year to fight back against rising prices. Let's get into it. So let's just cut right to the chase with the big question. You've done everything right, right? You've worked your tail off, you've saved diligently, you've built up this nest egg that's supposed to give you a nice, steady income. But what happens when the price of gas, groceries, you name it, just keeps creeping up? That steady income you planned for, how steady is it really? Okay, take a look at these numbers because honestly, they're kind of shocking. Let's say you retire with a plan to live on 50 grand a year from, I don't know, a bond portfolio. Sounds pretty good, right? Well, in year one, you're golden. But then inflation kicks in, and we're not talking about anything crazy, just a normal 3%. After 10 years, that $50,000 now only buys what $37,000 used to buy. And after 20 years, oh man, it's down to less than $28,000 in today's money. Your income stayed the same, but your actual purchasing power got cut almost in half. That's the silent killer we're up against. So here's how we're going to break it all down. First, we'll look at the strategy itself, the Dividend Queen's Gambit. Then we'll cover the risks. After that, we'll see why it can be so powerful long-term. And we'll wrap up with how to actually build a portfolio like this and what traps you absolutely need to avoid.
All right, so how do we fight back against that financial erosion we just saw? Well, the whole idea here is to shift your mindset. Instead of just looking for income, you start hunting for growing income. And that's the absolute heart of this Dividend Queen strategy.
And here it is, the official name: Dividend Growth Investing. And look, the most important word on this slide isn't dividend,
It's growth. We're not just looking for companies that send you a check every quarter. No way. We're looking for companies that have a long, proven history of making that check bigger and bigger and bigger, year after year. That's it. That's your automatic built-in defense against inflation.
So why is this so appealing? You can really think of it like a three-legged stool. Pillar 1, you get that steady income, those regular payouts. Pillar 2, you get a kind of built-in security. I mean, think about it. Companies that can do this for years aren't some fly-by-night startups. They're established, profitable, blue-chip companies. And Pillar 3, you still get growth potential. A company that's consistently raising its dividend is usually a healthy, growing company. And you know what that often means? The stock price can go up too. So you get income and growth.
Okay, now before we all get too excited and run off to buy dividend stocks, we need to pump the brakes. It's super important to remember this is still the stock market, and as we all know, there's no such thing as a free lunch. So let's talk about the risks, because they are very, very real.
In this right here, this might be the most important thing you hear today. A dividend is a privilege, not a promise. It's not like bond interest where they are legally obligated to pay you. A dividend is totally voluntary. The company's board can slash it or even get rid of it completely whenever they want. Never, ever forget that.
And if you want a case study in how real that risk is, just look at Boeing. I mean, we're talking about an absolute giant of American industry, a widows and orphan stock for decades. But then they got hit with a perfect storm. First, the horrific 737 MAX disaster, and then boom, the pandemic hits and grounds air travel worldwide. The financial pressure was just immense. So, in April of 2020, they did the unthinkable. They suspended the dividend. It's just a brutal reminder that even the biggest and best are never 100% safe. Okay, so this next one is a real reality check. Let's say you want to generate $10,000 a year in income. Not a fortune, right? And you want to do it with a company that's about as safe as they come, like Coca-Cola. Well, to get that 10 grand a year, you would have needed to have about $360,000 invested in Coke stock. Let me say that again, 360 grand for 10 grand a year. This really drives home the point that this is not a get-rich-quick strategy, not even close. It takes a ton of capital and a lot of time to build a serious income stream this way.
So this naturally leads to a big debate in the investing world. Is focusing on dividends really the best way to go? The other side of the argument is something called the total return approach. The idea is simple. Instead of waiting for a company to give you a dividend, you just create your own income by selling off a few shares when you need the money. And the big selling point here? It's all about control. You decide how much to take, you decide when to take it, you're not at the mercy of some corporate board's dividend calendar. It's a really interesting alternative to think about.
All right, so we've looked at the dark side. We've talked about the risks. We've talked about the counterarguments. But now, let's flip the coin over and look at why this strategy can be so incredibly powerful, especially if you have a long time horizon. This is where the magic really happens. So let's play out a little scenario here. Imagine you put 10 grand into a hot, high-flying growth stock, and you put another 10 grand into a boring, old, solid dividend growth stock, okay? The market goes on a tear for 3 years. It's a huge bull run. And, no surprise, the growth stock absolutely crushes it. It's up $7,000. The dividend stock, it's only up $4,500, even with the dividends. At this point, you're probably thinking, man, I picked the wrong horse. But wait, let's not stop the clock there. Let's keep it going for another 3 years. Only this time, the market tanks, and that high flyer, it comes crashing right back down to earth. After 6 years, you're left with a measly $500 profit. But now look at the boring dividend stock. Its price held up better, sure, but the real story is that it just kept spitting out cash. That dividend check kept coming, and it kept growing. That stream of cash acted like a parachute, cushioning the fall. And at the end of the full 6-year cycle, you're up $4,000. It just shows the power of patience through the ups and the downs.
And look, that scenario wasn't just some made-up fantasy. The history backs it up. This chart shows almost 50 years of data. The S&P 500, the whole market, returned about 9.9% a year. Pretty good. But the dividend aristocrats, those elite companies we'll talk more about later, they returned 10.4%. Now you might be thinking, 0.5%? Who cares? Well, you should care, because over an entire investing career, that tiny little edge, compounded year after year, turns into an absolutely enormous difference in your final nest egg. It's huge.
And that's why people call this an all-weather strategy. It kind of takes the guesswork out of it.
You don't have to stress about, oh, should I be in aggressive growth stocks now, or is it time to run for the safety of bonds? This strategy gives you the best of both worlds, all in one package. You've got the upside potential of stocks, combined with that steady, reliable income stream that helps you sleep at night when things get rough. It's built to last.
Okay, the theory is solid, the history is compelling, but how do you actually do it? Let's get practical now and talk about the nuts and bolts of building one of these portfolios.
Here's a pretty simple 3-step checklist you can use to screen stocks. First, look at their credit rating. Just like your own credit score, it tells you about their financial health. You want to see companies with a solid A rating or higher. Second, and this one's really important, look at the payout ratio. That's just the slice of their profits they're paying out as dividends. You want to see a low number, like 50% or less. Why? Because it means they have plenty of money left over to grow the business and handle any surprises. It means the dividend is safe. And third, don't try to be a hero. Start with the companies that have already proven they can do this for a long, long time.
And that's where this group comes in, the dividend aristocrats. This is like the Hall of Fame for dividend payers. It's a super exclusive club. To even be considered, a company has to be in the S&P 500 and, get this, it has to have raised its dividend every single year for at least 25 years in a row. Just think about that for a second. That means they gave their shareholders a raise through the dot-com bust, through the 2008 financial crisis, through the pandemic, everything. It's an unbelievable sign of financial strength and discipline.
All right, a couple more keys to success. Number one, and this is non-negotiable, diversify. We've all heard, don't put all your eggs in one basket, and it's doubly true here. Aim for at least 20 different companies in totally different industries. Now, if that sounds like a headache, there's an easy button. Just buy an ETF or an index fund that owns all the aristocrats for you. Simple. And finally, here's a pro tip. If you're still in your saving years, turn on the DRIP. That's a dividend reinvestment plan. It just automatically uses your dividends to buy more shares. It's like putting your growth on autopilot, and it will absolutely turbocharge your results over the long haul.
Okay, last section. We've talked about how to build the portfolio. Now let's talk about how to protect it. There are a couple of really common, really dangerous traps that you have to know how to spot and avoid.
First up is the big one, the one that gets everybody, the yield trap. It's so tempting. You're scrolling through stocks and you see one with a crazy high yield, 8, 10, maybe even 12%. It's like a siren song. But you gotta remember the old rule. If it seems too good to be true, it probably is. A super high yield is often a massive red flag. It usually means the stock price is cratered because the company is in trouble and that huge dividend is probably the next thing to get cut. When that happens, the stock price falls even further. It's a trap. A high yield is a warning, not a welcome mat.
And the other killer mistake is a lack of diversification. Man, did the 2020 pandemic teach us a lesson on this one. If you were loaded up on oil and travel stocks, you got absolutely hammered. ExxonMobil, a dividend-raising machine for 18 years, stopped. Disney, Southwest, Delta, some of the biggest names out there, just turned off the dividend spigot completely to save cash. All told, nearly 200 companies in the U.S. just stopped paying. It's the perfect and painful example of why you have to spread your bets around. It's not just a good idea, it's about survival.
So when you boil it all down, this whole strategy isn't about getting rich quick. It's not about trying to time the market. It's about patience. It's about becoming a part owner in fantastic, stable businesses and letting them share their profits with you, and then getting a raise every year. It takes time, it takes discipline, and it means always choosing quality over a flashy, high yield. So that leaves us with the final question, one for you to think about. Is this patient, steady pursuit of a growing income the right way for you to secure your financial future?
Hey, welcome. Trying to find the right investment portfolio, it can feel a lot like picking the perfect meal, right? You want something that really suits your taste, gets you where you want to go, and, doesn't give you any heartburn down the road. So today, we're going to dive into a strategy that's kind of like a gourmet tasty menu for your money.
Okay, let me ask you a simple question. Just picture this. You're at a party, you're standing by the snack bowl. Are you the type of person who carefully, meticulously picks out just your favorite things? Only the pretzels. Or are you the one who just dives in and grabs a big, messy handful of everything? Come on, be honest.
Because believe it or not,
Your answer to that little question says a whole lot about your potential investment personality. It really gets to the heart of being a specialist who hones in on one thing versus a generalist who kind of appreciates a little bit of everything. And if you're in that second group, if you're a handful of everything person, well, you are in luck because we're about to break down a portfolio that is designed just for you. We're calling this strategy the mega mix, and really, it's the ultimate solution for that investor who doesn't want to choose just one thing from the snack bowl, but really wants to enjoy the entire mix. So let's see what this is all about. This portfolio, it's for anyone who loves an everything bagel, right? Or the person who always gets the sample platter at a restaurant because you just want to try it all. It's for the person who sees the real value in variety and truly believes that by combining a bunch of different strengths, the final result is not only greater, but frankly, a whole lot safer than just the sum of its parts. All right, so if we're going to treat this portfolio like a recipe, then what are the key ingredients? Let's break down the 4 core components that really make the mega mix, well, work. See, each of these 4 asset classes has a very distinct job to do. The whole idea is to combine them so they work together, amplifying the good parts of each one while kind of tamping down the not-so-great parts. It's all about that synergy. First up, we've got U.S. stocks. Think of this as the main course of our meal. This is the big engine for growth. We're tapping into the really impressive historical returns and the incredible innovation of the U.S. market. This is where a huge chunk of your long-term gains will probably come from. Next, we add some international stocks. Now, this is the exotic spice in our dish. It adds that global flavor, that diversification. It gives you a piece of all the fantastic companies and the economic growth that's happening all over the world, not just in our own backyard. Our third ingredient is bonds. And this is the comfort food of the portfolio. This is the mashed potatoes, if you will. Bonds are all about stability. They provide that cushion. So when the stock market gets all choppy and volatile, bonds are there to help smooth out the ride. And finally, the fourth ingredient, dividends or REITs. Now, REITs, that stands for real estate investment trusts. They're basically companies that own things like big apartment buildings or shopping centers that generate income. So think of this final piece as the flavorful garnish, or maybe the sauce on top. This part is all about adding an extra stream of income to your portfolio, which can really give your overall returns a nice little boost. So, how do we actually mix this all together? Well, a pretty common starting recipe looks something like this. 30% in US stocks, 30% in international stocks, another 30% in bonds, and then that last 10% goes into those income-focused REITs or dividend funds. See how that creates this really balanced flavor profile? You get significant exposure to growth both here and abroad, but you've also got that heavy bond allocation acting as a really strong stabilizer. Of course, just like any complex dish, this one has a very distinct flavor profile. It's got its good parts and, well, some not-so-good aspects too. It's absolutely essential to understand both sides of this. So let's do a little taste test, and we'll start with the delicious parts. So what makes this mega mix so appealing? Well, there are 3 really standout benefits to this super diversified approach. First, it gives you a flexible risk cushion. By spreading your money across so many different areas, you're just not overly exposed if any single one of them takes a nosedive. Second, that leads to, well, relatively smooth sailing. You're probably not going to get those dramatic, exhilarating peaks, but you're also going to avoid the absolutely terrifying valleys. And finally, it helps you outsmart FOMO, the fear of missing out. Since you own a little piece of everything, you'll always be participating in whatever corner of the market happens to be doing well. Okay, so those benefits sound pretty compelling. I get it. But look, perfect investing, it's just an illusion. To give you the full picture, we have to talk about the potential drawbacks. So the biggest cons are these. First, it's just more to manage. This is not a set it and forget it kind of thing. It needs regular rebalancing. And that means you have to go in periodically, sell a bit of what's done well, and buy more of what hasn't, just to get back to your target percentages. Second, there's the cost of complexity. More funds can mean more fees, and those can add up over time. And probably most important, it's a jack of all trades but a master of none. You are never, ever going to capture the maximum possible gains from any single asset that's just skyrocketing. And this quote, this just illustrates that core trade-off perfectly. Because you own everything, your high flyers will always be held back, just a little bit, by your underperformers. If US stocks are going to the moon, well, your bonds might be holding you back from even greater gains. And that's simply the price you pay for stability. So you've heard the theory, you've weighed the pros and cons, and you're thinking, you know what? This recipe might be for me. So let's get practical. How do you actually turn these ingredients into a real live portfolio?
It's actually pretty simple when you break it down. Let's just say you're investing $300 a month. Following our 30-30-30-10 recipe, you'd put $90 into a US stock fund, 90 into an international fund, 90 into a bond fund, and that last $30 would go into a dividend fund or a REIT. See? It's a really straightforward plan you can just automate every single month. But before you start cooking, you have to be aware of a few fish bones you need to watch out for. The very first mistake is setting it and forgetting it. If your stocks do really, really well, they might grow to become 40, maybe even 50% of your portfolio, and that throws your whole recipe out of balance. You have to check in and rebalance periodically to maintain your strategy.
The second mistake is a lack of quality control. Look, diversification is not a substitute for due diligence. Having a variety pack of snacks is totally pointless if half of them are like expired cheese puffs, right? Every single fund you choose has to be a high-quality, low-cost investment on its own. And that means you have to actively look for funds with a strong track record and, this is critical, very, very low expense ratios. And the third and maybe the most critical mistake is having paper hands. That's investing slang for selling your investments at the very first sign of trouble. The entire point of this portfolio is stability. It's designed to help you ride out the market storms. If you get nervous and you sell everything when the market dips, you defeat the entire purpose of the strategy. You gotta stay put. And ultimately, that's what this is all about. Building a megamix portfolio is like being a chef. You are carefully combining all these different ingredients, not because any single one of them is perfect, but because together, they create a balanced, a resilient, and a really satisfying final result. So in the end, you really have to ask yourself, what's your investment appetite? Are you the kind of person who really values balance and variety over chasing the absolute highest possible returns from just a single source? Is the megamix the right flavor for your financial future? Well, only you can decide that.
Welcome back. You know, if you've been following along with us on this financial journey, I just have to say, congratulations. Seriously. You have put in the work, you've built this incredible foundation of knowledge, and now it's time for the best part, the most important step, moving from being a learner to becoming an architect. It's time to build a portfolio that is truly 100% custom-made for you.
So here's what we've got on the docket today. We're going to start by framing this as a new beginning for you. Then we'll dive right into your custom blueprint. After that, we'll cover a few key terms every architect needs to know, share some final advice on maintaining your creation, and then we'll look at how your journey continues from here. I really want to start with this quote because if you take away only one thing, let it be this. Personal finance is, well, personal. There is no magic formula, no one-size-fits-all portfolio that works for everybody. The only perfect portfolio out there is the one that's perfect for you, for your life, for your goals, and frankly, for your own peace of mind.
All right, let's get into our first section. And look, this is more than just a new topic we're talking about. This is a completely new beginning. You're making a huge shift right now, from just soaking up information to actually applying it in a way that is going to shape your entire future.
No, really, just take a second and appreciate how far you've come. You get the concepts, you know the lingo, you've seen the options laid out. I promise you, your future self is already giving you a high five. So let's take all that hard-earned knowledge and build something real with it. And now for the really hands-on part, your custom blueprint. I want you to think of this as your personal a la carte menu for building a portfolio that fits you and only you perfectly. This is not a test. There are no right or wrong answers here. This is a menu of pure possibilities. You're the head chef in this kitchen. You are in complete control of the final recipe, and you get to pick the ingredients that suit your taste, that suit your financial diet. You decide what goes in, and you decide how much. So what's on the menu? First up, we've got funds. These are your big, broad-stroke investments. You might decide to put a certain percentage into a total stock market fund. That's going to give you maximum diversification across thousands of US companies, big and small. Or maybe you want to focus on the big guys, right? Then you could choose an S&P 500 fund and invest in about 500 of America's largest corporations. And hey, to get some global exposure, you can slice off a portion for international stock funds. Or get a stake in real estate without the headache of being a landlord by using REIT funds. Next course, individual stocks.
Now, if you're someone who actually enjoys the research, you like to get your hands dirty, you can allocate a percentage to specific companies you really believe in. And you can tailor this to your own style. Maybe you're a value investor, always on the hunt for solid, underpriced companies. Or maybe you're all about high-growth stocks, betting on the next big innovators. You could even build a little income machine for yourself with a portfolio of dividend stocks.
Then we have individual bonds. These are absolutely fantastic for adding stability and some predictable income to the mix. You could go for the super high safety of U.S. Treasuries, which are backed by the full faith and credit of the government. Or you could opt for municipal bonds, which often have some nice tax advantages. Or if you're seeking a little higher yield, you can lend your money to businesses with corporate bonds. The mix, again, is totally up to you.
And finally, for those of you who are looking to add a little spice, a little more diversification, we have the alternatives category. This is where you might allocate a small percentage to things like cryptocurrency, maybe individual real estate properties, or even investments that really align with your personal values through social impact funds.
Okay, a quick heads up before you decide to order one of everything on the menu. While variety is definitely a good thing, just remember that complexity has its own cost. The more individual things you own, the more time and effort it's going to take to manage it all and rebalance it. The goal here is to build a portfolio that you are comfortable and willing to maintain for the long haul. Okay, so you've got the menu. Now let's quickly review 3 key terms that make up your essential toolkit. I mean it. Mastering these concepts is absolutely crucial to using that blueprint effectively. First up is asset allocation. Look, this is your master plan. This is the single most important decision you are going to make. It's how you decide to divide your money among the major categories: stocks, bonds, alternatives. Believe it or not, this decision will have a bigger impact on your returns than pretty much anything else. Next up, diversification. You've heard it a million times. Don't put all your eggs in one basket. Well, it's timeless wisdom for a reason. By spreading your investments out, you dramatically reduce the risk that a big downturn in any single area is going to have a devastating impact on your whole portfolio. Think of it as your primary defense against the unexpected twists and turns of the market. And finally, risk tolerance. And this is all about you. It's about being really honest with yourself. How would you feel? How would you react if the market suddenly took a nosedive? Are you someone who can sleep soundly at night with a more aggressive, stock-heavy portfolio? Or do you prefer a smoother, more conservative ride? Knowing this about yourself is the key to building a portfolio you can actually stick with when things get choppy. Building your portfolio is a huge accomplishment. It really is. But just like any well-built house, it's going to require some maintenance to make sure it stands the test of time. So let's talk about how to take care of your portfolio for the long haul. So the most important maintenance task is something called rebalancing. You see, over time, some of your investments are going to grow faster than others, and that's going to knock your original plan, your asset allocation, out of whack. Rebalancing is just the simple process of trimming your winners a bit and adding to your underperformers to get right back to your original target percentages.
And as you can see here, the process is incredibly straightforward. First, you set your targets. Let's say 60% stocks, 40% bonds. Simple. Second, you just check in on your portfolio periodically. Maybe once a year is plenty. If you see that your stocks have had a great run and now they're 70% of your portfolio, you just adjust. You sell some stocks, buy some bonds, and get right back to that 60-40 target. That's really all there is to it.
You know, a huge part of maintenance is actually psychological. It's the head game. You're going to have to steer your portfolio through good times and bad. You'll get to experience those exciting bull markets where everything seems to be going up and you feel like a genius. And you're also going to have to endure some painful bear markets where things are declining. Understanding that both of these are normal, they're temporary, and they're just part of the long-term investing cycle, that's what is critical to staying the course and not panicking. We are getting close to the end of our time together today, but your personal journey is really just getting started. So let's wrap this up by looking at some really excellent resources for the road ahead. Investing is a lifelong journey. It's not a destination you just arrive at. And the most important thing to remember is that you are not alone on this path. The world of finance is always changing, so being a continuous learner is key. And luckily for us, there is a ton of incredible information out there to support you. And I mean, just look at the breadth of support that exists out there. It goes so far beyond just picking stocks. You'll find resources for broad financial literacy. Yeah, but also for very specific real-life challenges. Things like managing medical debt, protecting yourself from fraud, or even getting help with something as serious as financial abuse. It's such a powerful reminder that our financial health is deeply, deeply connected to our overall well-being. And that right there brings us full circle.
You started this process as a student, and now you have the knowledge, you have the tools, you know what you like, you know what you don't like, and you know what feels right for you. This is your moment. The power is completely in your hands now to take everything you've learned and to execute your unique vision for your future. So I'll leave you with this final thought. You are the architect. You've got the blueprint, you've got the tools, and you have the knowledge. The only question left to answer is, what will you build? The next chapter is all yours to write. Thanks so much for joining me.